China, among the most in-debt nations, has skillfully avoided a full-blown financial crisis. Despite close calls such as a 2019 bank seizure and a wave of developer defaults in 2022, China has emerged seemingly unscathed. Tightened regulations on local banks and home builders contribute to increased investor confidence. However, one lingering concern is local government financing vehicles. With LGFV debt reaching 57 trillion yuan, that's $8.3 trillion in 2022, 48% of China's GDP, this looming issue begs the question, can China continue to avert financial disaster? LGFV borrowings are almost the same size as official central and local government debt combined. Bank loans aside, these vehicles routinely raise money from corporate bond issues, accounting for over 40% of the total market. Their outstanding amount reached about 36 trillion yuan last year. Investors are nervous. LGFV's ability to service their debt is worse than developers, in that their mandate is non-profit and to provide public services. The average return on asset among LGFV bonds was only 0.4% in the first half of 2022, according to data compiled from Gavical Dragonomics. Meanwhile, these 1,800 users are not compensating buyers for the risk they take, paying on average only 4.3% interest. To make matters worse, after the property slump, municipalities may not be in a position to help out their LGFVs even if they wanted to. If anything, it's the other way around, with local authorities resorting to LGFVs to fix their fiscal problems. In 2022, as developers retreated to repair their cash flows, these entities snapped up more than half of the residential land sold, worsening their balance sheets further. Already poorer provinces are lobbying for a central government bailout. In a now-deleted online post, Guizhou in landlocked central China said that it was struggling to solve its debt problems. In December, Zhongyi Road and Bridge Engineering Construction Group, a local LGF, got a partial bailout from its lenders, swapping short-term borrowings into a 15.6 billion yuan worth of low-interest 20-year loans. But that was apparently not enough. Another LGFV in this province, best known for its fiery Beijing, was on the verge of reneging on a bond last year. Despite Beijing's history of successful large-scale bailouts, and the current 57 trillion yuan in LGFV debt presents a significant challenge. While poorer provinces have smaller outstanding LGF debts, allowing potential debt swaps into official government bonds, this strategy may falter if more prosperous provinces trigger a financial scare. These prosperous regions, being the largest issuers, could overwhelm Beijing's ability to manage the situation, potentially leading to China's Minsky moment and the arrival of a long-anticipated financial crisis. In conclusion, there's a brighter story to tell about LGFVs in that they have built a cheap, quality service for the public. Unlike the US, people in China can ride high-speed trains and take road trips at little cost. But the economy is now at a stage mature enough that fiscal authorities have to figure out how to pay for all that infrastructure. Beijing will have to tread very carefully this time.